StockViews.com, the community for serious investors.
How to read a balance sheet. Often the balance sheet is overlooked in favour of the P&L statement. However, for investors and analysts who are willing to dig deeper, an exploration of the balance sheet can yield a great deal of useful information that hasn't been considered by others. Typically, investors use the balance sheet for one of three reasons. Firstly, to compare market values to book values as a valuation tool. Secondly, to monitor for financial and business risks. And thirdly, to calculate return on invested capital, ROIC, which tells an analyst how efficiently a company is utilising its capital. Let's start with an overview of a typical balance sheet. On the left side, we have the assets. These are split into current assets and fixed assets. Current assets include cash, securities, and other assets that can be liquidated within a year. Fixed assets, by contrast, are assets that are used by the business for production purposes or are unlikely to be liquidated within the next year. On the right side, we have liabilities and equity. Current liabilities represent the debts and obligations falling due within the next year. Long-term liabilities are for debts and obligations falling due after 1 year. Equity and reserves represents the ownership interest of equity holders and by definition will equal the assets less the liabilities. This is also equivalent to the book value of the company, representing the accounting value of what is owned by shareholders. Let's take a look at a real-world example now, the Hershey Company, as of September 28, 2014. For comparison, we also show the balance sheet as at the end of 2013. We start with the current assets. Cash is the first line, and we see that it's been reduced substantially. We could find out why by going to the cash flow statement, but this will be the subject of a lesson in the future. Then trade receivables. Trade receivables are often expressed as days of sales outstanding, or DSO. We obtain this ratio by dividing trade receivables by annual sales and then multiplying by 365. Calculating this out, we find that DSO have increased from 24 days at the end of December to 39 days here. This implies that Hershey has become less efficient at collecting receivables. Now, there may be a seasonal change going on here, but it's something that's worth exploring further. Inventories next. Here we can calculate days sales of inventory if we divide by annual sales and multiply by 365. We find that the company is now stocking 45 days worth of inventory, up from 34 days at the end of December. Again, all else equal, this implies less efficient inventory management. Other current assets on the balance sheet include deferred income tax and prepaid expenses. Deferred tax usually arises because the tax treatment of profit is different to the accounting treatment. After this, we have prepaid expenses and other assets. Adding together all of these items give us the total current assets. Now let's move on to the fixed assets. Property and plant is the biggest account here. To get more details on this, we need to delve into the notes to the account, which will usually yield much more information. Goodwill is created as a result of past acquisitions. It represents the premium paid over the book value of the assets acquired. Other intangibles in this case includes items like trademarks and patents. Then other assets, which here includes items like derivatives and equity investments. We add together current assets and fixed assets to arrive at a figure for total assets. Now on to the other side of the balance sheet, where we start with current liabilities. Short-term borrowings represent the debt of the company, which falls due within the next 12 months. Accounts payable next, which can be expressed in terms of days payable outstanding. To calculate this, we divide accounts payable by cost of goods sold, and again multiply by 365. We see that days payable outstanding has increased from 41 days to 44 days. This suggests the company is managing to hold creditors off for longer before paying them. Then we have accrued liabilities and accrued income tax. Adding together all of this gives us total current liabilities. Next comes the long-term liabilities. Long-term debt represents a debt of the company that falls due after more than 1 year. Other long-term liabilities and deferred income tax are added here, and we can then calculate total liabilities. Finally, the total stockholders' equity represents the capital of common and preferred shareholders, retained earnings, other reserve accounts, as well as the capital of minority interests. That completes our study of the balance sheet. Why don't you show us what you've learned now on the StockViews platform? You can contribute your own stock analysis and opinions and interact with other like-minded investors. In the next lesson, we're going to take a look at some of the metrics and ratios that are commonly derived from the balance sheet. Thank you for listening.
StockViews.com, the community for serious investors.